Money Radio for a really great future. We're talking real money.
Thank you for being part of Talking Real Money. You know, we're here 5 days a week, plus Saturdays live on the radio to help you understand money. More on investing than necessarily spending, but we do talk about that from time to time. And every once in a while, we're really happy to have Roxy Butner, one of our advisors, join us, and she'll be on in just a moment. But first, I want to warn you about something that has snuck up on me because I don't pay close attention to these, but penny stocks. Penny stock IPOs, initial public offerings, the numbers are shocking. In the last year and a half, 164 of them have rolled out on U.S. exchanges, primarily the NASDAQ. Compare that number to the 20 years prior where only 106 total came out. And people have been talking about gambler spirits being revived on Wall Street, et cetera, et cetera. And who is buying these things? Who is running? And this is absolutely horrible because we're hearing about people drawn to these investments with small chances of massive payoffs. Doesn't that sound like a kind of like a lottery ticket or something? And Larry Swedroe wrote recently, from a traditional finance perspective, this behavior is irrational. These investors knowingly chase high volatility stocks with lottery-like return distributions, despite overwhelming evidence of their poor long-term performance. Let me give you a couple of numbers if you're even thinking about this, okay? Among 2024 penny stock IPOs with a one-year track record, share prices declined an average 37% from their offer price. If that's not bad, from 2001 to 2023, the average three-year decline of an IPO, 62%. Let me say that again, 62% decline in 3 years. Now, again, to step back, because if you're really thinking about this, any IPO, you need to know that IPOs have a lousy track record, that there's a lot of volatility, and usually the price does not appreciate much in the first few years. And yet these are these really, really low ball IPOs. Penny stocks continue to proliferate and attract retail capital. Stay away from this stuff, will you? I mean, you know the rules. Build a diversified portfolio. Keep your costs low. Be tax efficient. Quit messing around with this stuff because it will burn you. But that number of all those, Roxy Butner joins me here. That's a crazy number to see so many of these IPOs in a year and a half, basically, compared to the previous 20 years. Nuts.
Mm-hmm. I think it's just kind of a reflection of all the other sentiment that we're seeing online with all this, alternative investments and risk takers, and, you can win big for quick, and yeah.
It's just, boy, it scares me because it feels like what Joe Kennedy and the shoe shine guy. The market is at a top when these kind of things happen. So avoid those things. Have the proper asset allocation. Be broadly diversified, and don't get sucked in by what looks great. Well, one of the things that you've been kind enough to do is send us a lot of questions. We love getting them. You go to talkingrealmoney.com, click on Contact Us. You can send them in. You can read them in. You can do whatever you like. Roxy, from time to time, takes a break from her busy schedule talking to so many of you and joins us here on the program to take up a few of these questions. And we got a few, don't we? So what do you got? Go ahead, hit me.
Let's see. Our first question is from Lawrence in Denver, Colorado. I have been with Fidelity for 30 plus years. During a recent check-in meeting with an advisor there, I was pitched an annuity. This was very off-putting, and I'm considering leaving them entirely. Is this just a fact of the industry now? Will Schwab and or Vanguard be moving into pitching annuities too?
Here's the thing. I have a very good friend who works at Fidelity, and when he took the job there, he walked in and told them, here's what I'm going to do, but I'm never going to do annuities. I'm not going to do your high-expense actively funds. I'm only doing this business. But the pressure on everybody else, he tells me, is there. Because management wants these products moved. They pay out more to the company, even though they're probably going to pay you less. So it's a possibility. The major houses, none of them. Now Vanguard, I'm not sure, but they're not 100%. They're not 100% fiduciary advisors. Fidelity's not. There's people there that are hawking products. But what's your take when you read something like this?
I mean, just from the feedback from people I've spoken with, our listeners, I've been hearing about Fidelity pitching annuities for a while. I still think they have some good index funds. And I think if you're using Fidelity as a custodian, as a platform, it's still great. But in terms of their advisory services, I would have to, be more cautious talking to someone from Fidelity than someone at Vanguard, for example. So it's just important to know.
Yeah, and again, because they're not 100% fiduciary, because in a large institution, well, in any institution, there's pressure to be more profitable, right? They need to sell these products, and those products, as I said, pay the company a whole lot more than what you just mentioned there, the low-cost index fund. So you got to pay attention. Should you leave them? That's a personal decision. If I was thinking about the world, though, I would only want to work with somebody who's a 100% fiduciary advisor, and they are not, sadly.
I am curious if Vanguard would ever take.
Yeah, I don't know if the
move in that direction.
Yeah, well, I know. And by the way, Vanguard recently, we've discussed this briefly on the program. They're going to allow more in the crypto area because the pressure's been on, and they're like, "Hey, people want this, so we should give it to them." You know our feelings on that. People want chocolate cake every night after dinner too. They can't have that. So, well, they could, I guess, but that's not suggested. So, yeah, this is one of the problems with the financial industry is it is not designed in your best interest for the most part. It's designed in their best interest. So that's a sad story to hear.
Yeah. Okay, we've got another question from, I really hope I don't screw this name pronunciation up, but it's Quabina.
Yeah, I think that's exactly right.
From Toledo, Ohio. Should I invest differently? Hello, gentlemen. I am a fan of the show. Keep up the good work. Could I retire in 8 years? Am I diversified enough? I have followed The Simple Path to Wealth by J.L. Collins thus far, and it has served me well. The more I listen to you guys, I think I may not be diversified enough or not at all. This is my scenario. I'm 47, wife is 43, have $2.2 million invested. $209,000 at Vanguard, invested in VTSAX, $228,000 in the TSP-C fund, and $1.18 million in a Fidelity Solo 401k, in FSKAX, and $587,000 in a Vanguard taxable account invested in ITOT and VTSAX. I scored 75 on your risk assessment, plan to work 8 more years, plan to save $200,000 a year for the next 3 years, then $100,000 for the last 5 years. Kids 529 funded, not included, spend $150,000 a year now.
Okay, so just Quabina, the challenge here is, at least for me, Roxy does this more every day than I do, is taking all these facts and saying you're going to be okay. It sounds like, $2.2 million in your 40s, that's a lot of money. All the money you're going to save into the future, that sounds pretty good. But there's a lot of things that could happen between now and the time you actually quit. Having the right portfolio design is going to be important. So I'm very uncomfortable doing these back of the envelope, like, well, you have this much, you're going to save this much, you're going to make this much. If you wanted to get serious about it, I would have somebody really sit down and do a plan. But what's your take? And I didn't get a chance to look at the asset allocation either, so to make a decision.
I ran a couple numbers looking at it. The question of, am I diversified enough? I would be comfortable saying no, because there's actually zero international in all these funds.
Yeah, we want to have that global diversification.
There's going to be very little small cap because a lot of these funds like FSKAX, VTSAX, those are giving you large U.S. stock exposure. You're really not going to have a lot of small cap. You're going to be pretty heavily tilted towards growth. And I think there's basically no bonds except for the $228,000 in the C fund.
And his overall risk tolerance, if you will, was 75%. In stocks, 25%. So he needs to increase international, increase bond exposure probably. And then honestly, if I were you, Quabina, I would get a plan, because if you really, this is something you want to know, you're young, that's great. I always tell people, when you get to about 50, you should at least have somebody look at your situation and say, I'm headed the right way, because there's no guarantee. But somebody like Roxy could help you understand it far better than just us doing this off the back, as I say, of an envelope.
Especially because they want to retire in 8 years and they're only 47. So
what are you going to do, by the way?
That's going to be at 55. That's pretty early to retire. So you have to make sure, do you have enough taxable assets to pull from before 59 and a half? Do you have plans for health care, which can be very expensive before age 65 when Medicare kicks in? And just other unprecedented expenses that you make sure you're counting for. Because again, 55, you got another 45 years of possible living. You have to factor in possible moves, medical expenses, weddings for kids,
There's
things like that.
There's a lot of stuff there that could happen. Yeah, and you got to design the other part, purpose. 55 is so young. I can't imagine maybe you'll do it because you're doing great at such a young age, and maybe you have a lot of things that could occupy you. Okay, that's good, but that would be high on my list if I was going to leave my employment at age 55. Great question. I think you should get some more detail around that, redo the portfolio a bit, especially the stock-to-bond ratio, and especially, as you say, you should have some of those international stocks in there, which have had a robust year, the best, better than U.S. large cap, which is a nice thing to say after all this U.S. large cap outperformance, if you will.
Have you heard of J.L. Collins, Tom?
I was trying to remember. I'm going to look all JL up right now while you're working on the next question.
Yeah, I think it's just a book on personal finance. It seemed like pretty good content. I mean, general 4% rule, talks about inflation, keeping stocks simple. So, yeah, I'm curious to look into it more. Okay, let's see here.
It says he's a key figure in personal finance, advocates for simplicity in investing, focusing on low-cost index funds and financial independence. Well, that sounds pretty good right there to me. So, but the devil sometimes could be in the details.
That's true.
But we could take a look at that. But go on. What else we got?
We've got Daniel from Cottonwood, California, and they're asking a capital gains question. I'm male, married, and 72, as well as my wife. In our brokerage account, if I buy a 12-month CD, I will be taxed at regular income rate for the interest. However, my thinking is if I buy a 13-month CD, the interest will be capital gains, right? Since our income is far below $96,000, that interest money would not be taxable, being in the zero capital gains bracket. Am I thinking correctly? If so, I sure could have saved a lot of taxes in the past. Love the show.
Okay, so now from what I know, CD interest is taxed even if you don't get the money, I believe. So if it's paid out in that period of time, then you have to pay it. Number two, I didn't know if you held it longer than a year that it goes into capital gains. Is that true or not? You're shaking your head. It looks like the answer would be no.
No.
Yeah.
So CDs, even if they're brokered, which just means you purchase a CD within a brokerage account, all of that interest income is taxable as regular income at your normal income tax rate. Capital gains refers to investments where you realize a gain. And if the gain is over a year, then it becomes a long-term capital gain. Not the case with brokered CDs.
So there's no real advantage to taking 13 months, somehow tricking the tax man into thinking, well, and as I said, I believe you have to pay tax on the interest whether you get the money or not, I think, if I remember right, from CDs. So,
yep.
Yeah, that's these tax questions are always so cumbersome. But there's another idea here. You could use municipal bonds that are still paying out pretty well. The Vanguard's got a wonderful municipal bond fund, VTEB, that has a lot of different bonds. You get diversification there. They do it at a very low cost, and you could own that instead.
Or municipal money market funds.
Yeah,
you can always look into those. The yield on those are going to be a little bit lower, but generally, depending on your tax rate, it could be beneficial. So you have to look at that. Yeah,
but those would be ways if you really wanted to make sure that you weren't paying taxes on interest just the way that you're going to as regular income. Very important thing to note that will be at your regular income rate. All right, we got a lot of questions. By the way, if you want to send in a question, you can go to talkingrealmoney.com, click on Contact Us. And if you want Roxy to read, you just put that in the note, too. If you want to have her back here sometime this fall, glad to do it. She's very busy, but she's very kind to take time to do this. So and by the way, what have people been asking you about lately? You talk to a lot of people every day.
We're heading into the end of the year, which means required minimum distributions for folks over 73 and Roth conversions, whether we want to do that, and just kind of tax planning to see if there's anything we can do to optimize, taxes at the end of the year. So busy season.
There's not a lot of tax loss harvesting this year because bonds have been good, stocks have, I don't think there's any part of the overall global stock market that's lost money this year, right?
No, there really hasn't been. So when we're looking at, losses or gains, really seeing gains all across the board. But I think we're a couple cases that have come up, people passing away, unfortunately, and then taking a look at, okay, this is the last year we're in a joint filing status, taking advantage of those opportunities in the years that you can, and just one-off things like that, but lots of taxes.
Yeah, taxes, it's the partner in your investments that you'd prefer not to pay attention to, but you really have to. And a lot of the mistakes we see are people not having the right assets in the right accounts. That would be one. Buying and selling things when they don't necessarily have to or doing it incorrectly. and not understanding cost basis and things like that, right? That where they overlook kind of the bigger questions before jumping in and making a move.
Yeah, absolutely.
So tax questions. So good luck. That sounds like a fun fourth quarter to me. Good Lord.
No,
All right, what else
fun.
we got?
Okay, so this is a fun one, actually. This is from Emily in Warren, Ohio, and her subject is young and dumb. But she says, and it's a little lengthy, so bear with me here.
Take your time.
Hi, Tom and Dawn. My name is Emily. I'm 21 years old, and I am from Northeast Ohio. I graduated this past spring from Miami University in Ohio and have my first big girl job in statistical analytics and data analysis.
That takes me out right there. So go keep going, Emily.
To be honest, I started listening to your podcast by mistake. You two were discussing something non-money related. I think Tom's Airstream.
Okay, now we're going to have a slight correction there. That would be Dawn's Airstream. Yes. I've made mistakes before, but not of that size nor nature. So.
And when I found out the podcast was called Talking Real Money, I was a tad disappointed. With that being said,
Wait a minute. I got to unpack that a little bit. What does that mean? The name doesn't work?
21-year-old, who cares about money at that age, I guess.
Okay. All right. Fair enough. Okay.
She's probably looking for a travel vlogger.
Okay. Well, we could do that too. We're all travelers here. Sure. Why not?
With that being said, I tuned back in and was almost like a message sent from the investment gods because I have listened to about every podcast since. Great job.
By the way, do you know how many podcasts we've done now, this iteration, Talking Real Money? Dawn just told me 1,800. Very close to 18. That's a lot of podcasts.
That's a lot.
So Emily, if you're really looking for a full-time job, you can go back. Don't do it. I'm just kidding.
I recently opened a Roth IRA brokerage account about a month ago, and I deposited $6,000 into it. Yes, I have made that dollar amount in 2025 because I worked during the school year, during Christmas break, when I was home and on campus. My question is what I should be doing with the $6,000 just sitting there and the money I will add to it in the subsequent years. Based on 2 months of listening to your podcast, my thought is to go 80% in the stock market and 20% in bonds. Specific to the market, 60% U.S. and 20% international. This is where my 2-month financial education comes to a screeching halt.
I appreciate your honesty.
I'm not sure if I should go the AVGE route, VOO, or some other option. Which, by the way, 2 months ago, I had no idea what those even were. There is a significant cost difference to purchase, but is it worth it long term?
Now, that's a great question. Okay, keep going.
I will be making a monthly contribution to my account moving forward, so I'll have the opportunity to invest more. My long-term plan is to build this account for at least the next 40 years. I'm okay with risk, and I know time is on my side. I don't plan on following the market very closely and making reactive adjustments on the fly. I learned that from you guys. My parents are not very financially literate, so they can only help me so much. They have been employed as state and county employees, so they have PERS, STRS, and the deferred compensation plans, and they have never had to make those decisions. They went to work, and their investments took care of themselves. With that said, they started 529 plans years ago for me and my sister. They paid for my entire tuition and living expenses while in college, bought me a brand new car for graduation, and encouraged me to move back home and save money for at least 1 year after I graduated. So other than $23.61 balance on my credit card,
$23.61. Well done there.
which right now they still pay, I am debt-free. Thanks so much for your advice, and with all the help on your show, I'm not sure exactly how many 21-year-old loyal listeners you have, but now you have at least one. Emily from Ohio.
Yeah, we don't have a lot of 21. We have some, but not a lot, because I've talked to a few of you on the phone. Okay, so let's just go back and unpack this a little bit, Emily.
Yes.
First of all, this is great. You've got the Roth contribution, and this is a problem we see people have too. They oftentimes make these deposits and then they forget you got to
just leave them there.
They got to be invested. Vanguard has found this with IRAs and I believe 401k rollovers where the money's moved over and then people don't bother to invest it. I'm going to let you take the lead on this one because it's $6,000. She's got 40 plus years till she uses this money. What would you recommend here?
Well, let's start with a few of the points that she mentioned. So one of the first things she says is she's thinking she wants to go 80% in stocks and 20% in bonds, which at 21 years old, I'd say probably not.
Yeah, I'm going to want a 100% stock portfolio at that age. So and you're going to have to take the ups and downs, the pain that comes with the gain, but that's just, we really don't want to have you have a bunch of bonds at that. In most ways, you're guaranteeing yourself a lower return for a long period of tax-free growth.
Yes. So bonds are out of the question here. So then specific to, I think she meant the stock market, she says 60% U.S. and 20% international.
Really, which leaves another 20, I guess 20% goes in your pocket or something for the advice? Or
maybe she was thinking 20% towards the bonds.
Oh, I see. Okay.
But I think to clarify, when we look at the global market right now, it appears that the U.S. stock market makes up about 65 to 70% of the total global market. So I think it's a fair assumption to try and target about 65 to 70% U.S. and the rest 30 to 35% international.
But if you buy a one fund, you don't get that choice anyway, and I believe AVGE is somewhere around that. We did a show on that a few back, looking at AVGE, DFAW, and Vanguard VT, thank you. And I picked, by the way, AVGE after looking at all the facts, and she's right. It is a little more expensive, but we expect outperformance due to its commitment to smaller companies, commitments to value companies, profitability, some of the factors that Fama and French and others have found. But continue.
Yep. So then that does bring us to her question of, okay, AVGE or VOO, which I want to make an important distinction here. So yes, there is a cost difference, but they're entirely different funds with entirely different allocations. So VOO is going to track the Vanguard S&P 500. That's just going to be your top U.S. 500 companies. AVGE, as Tom just mentioned, is really tracking the entire global economy with a focus on factors like small value, making sure you do have enough international, making sure you do have enough emerging markets. So it's really an all-in fund that you can get for just one fund. So I agree with Tom. I'd probably say just keep it easy, stick with AVGE for now, keep investing every time you make those contributions. And then, reassess every few years.
And we're going to take up a collection hat here, see if we can pay off that burgeoning credit card debt you have of $23. We'll see who wants to kick in today, see if we can get some of the money out of these advisors. That is really good advice. Yes, so you want to be global, you want to be all stock to me, and you want to do one fund. I see no reason to own more than one fund in this circumstance. It's going to be a set it and forget it. You're not going to have to worry about it, and check it every 6 months. Don't look at it too often because it's going to be volatile, right? It's going to go up, it's going to go down. Sometimes you might be uncomfortable, but I'm like 23 years old and I'm not using this money for 40 years. So that's a very important thing to do. So, hey, these are really good questions. And guess what? Even better, your answers are even better. So thank you for that.
Thanks, Tom.
It's always a pleasure.
It's a lot of fun.
It's always a pleasure to have Roxy on here. If you want some of her help, you can go to talkingrealmoney.com and click on either contact us, ask an advisor. We're here to help you and make that all happen. And guess what? We will be here doggone near every day continuing Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.